Okay, so we go on to number 6, reinsurance. And here's maybe a lot of times where we see another question here. Okay, so with reinsurance, this is a special type of insurance company that sells only to other insurance companies. Companies do not sell to the general public. So let's say that I operate an insurance company and we sell down here to the public. We can actually purchase an insurance policy from a reinsurance company. So we pay them a premium. They sell us a policy, and the policy states in it how the reinsurance company will pay. So essentially what my insurance company here is doing is reinsuring a portion of our risk to the reinsurance company. We're spreading that risk, sharing that risk. You see this done a lot of times in high value insurance. Could be done in life insurance, could be done in commercial property insurance, maybe higher risk insurance. You could possibly see reinsurance utilized, but a big, best known example of the general public would be the World Trade Center. When we had the total losses one day, total losses to both World Trade Center. Policy limit, both policies, $1 billion per building. Okay, so think if you were the insurance company that wrote that policy. Obviously thinking there's never going to be a situation where there's a total loss to either one of those buildings. But if there is, you're on the hook for $1 billion. How'd you like to pay that claim? Well, you're probably going to go broke paying that claim. So why don't you do this? Why don't you spread this risk around? This kind of facilitates this marketplace. So we could reinsure a portion of our risk for the World Trade Center to a number of different insurance companies, so we're not on the hook for the full amount. Now, when we purchase reinsurance, the insurance company purchasing the reinsurance is referred to as the ceding insurer. They're seeding, planting a seed with the reinsurance company. Now, the contract can be written a number of ways. As we'll take a look there in the book, let's see on page 5. Top of the page, second paragraph. It says excess of loss basis, where we just state a certain dollar amount. If there's a loss over and above that, then the reinsurance company comes in and pays. Or it could be a quota share basis, where we list a fixed percentage of the policy that the reinsurance company will pay a fixed percentage of certain losses. Now there's also one that you'll need to write in there, if it's not in there, which is called facultative. And facultative reinsurance is when the ceding insurance, this is a type of reinsuring agreement, when the ceding insurer decides individually what risks they want to reinsure with the reinsurance company, and the reinsurance company therefore determines and underwrites each risk individually, instead of kind of like an overall umbrella type policy. Okay, that's facultative reinsurance. Okay, so we go on to number 7. We have a captive insurer. These are kind of rare. And generally the general public has never heard of this because captive insurers do not sell insurance to the public. So here's an example of a captive. It's pretty unlikely you'd see a question on it, but kind of so we understand here. Say we have a group of doctors. Now, these doctors sell, or not sell, but they perform plastic surgery. Okay, so the doctors, they specialize in plastic surgery. Well, there's one expense these doctors have, and all doctors have, that are very expensive, and that's malpractice insurance. So that's a type of insurance most everybody's heard of. In case a doctor amputates a wrong leg on accident. You know, whoops, well, that's malpractice insurance. There's going to be a big lawsuit related to that, and doctors need that. Okay, it covers accidents. Well, say that we're one of these doctors that does plastic surgery. Our malpractice is very expensive. Okay, so the premium we pay for it. And beyond that, let's say we've never had a claim. Okay, we've been doing plastic surgery for 25 years, never had a claim, and our rates for malpractice are getting so high we might have to close our doors. So here's what we do. We group together with a bunch of other doctors, we talk about this problem that we're having, and we decide we're going to create an insurance company. So we create a captive insurer. The insurer is captive to its owners being the doctors. So we create this captive insurer for one purpose and one purpose only, to sell malpractice insurance to ourselves. So this is a separate business entity. It's an insurance company. It would have to get authorized just like any other company, meaning meet the state requirements to sell. The doctors would have to put the money up. They probably have to hire an attorney, somebody to help them draft all the paperwork, file the documents at the state, all that good stuff. But here's the question. Why would the doctors do this? What do you think? What's the main objective? To save money. So they figure, hey, we're not going to have any claims anyway. Why don't we just create this captive insurer in case we do have a claim? But we definitely think it's going to be a lot cheaper than having to continue to pay our premiums to this third-party insurance company we're currently having our malpractice insurance through. Okay, so that's an example of a captive insurer. Created by its owners, sells insurance only to its owners, and they also create the policy forms. We go to the next one, number 8, excess and surplus lines. Excess and surplus lines insurance is insurance that they sell insurance that cannot be placed through the normal marketplace. So when we talk about surplus lines, probably pops in your head the most well-known type of surplus line insurer is called Lloyd's of London. They are a type of surplus line insurer. Okay, well, this type of coverage you hear about in the news every so often. In fact, Britney Spears, she's in the news all the time. Well, she had a type of policy that paid if she got injured while she was on tour and had to cancel her tour, it would pay her out for the loss of income she would have had for the rest of the tour. So we're talking millions and millions of dollars. Well, just that thing happened a while ago where she got injured and she couldn't complete her tour, and then she turned a claim into the surplus lines policy, and it went on from there. Well, it's a surplus line type coverage. Supermodels insuring their legs. David Beckham, the superstar soccer player, has his legs insured for $70 million. Surplus lines. Okay, so high risk. Now, one thing with the surplus lines insurers like Lloyd's of London, they do not have to be licensed in the state to sell. However, the people that represent them do. So the people that represent surplus lines insurers are called surplus lines brokers. They have to be licensed, however, the surplus lines insurer itself does not. Okay, so we go on to number 9, government insurers. In situations that are so high risk, no insurance company is willing to cover it, even surplus lines. That's when sometimes the government will step in, such as flood insurance. Okay, flood insurance is very high risk. However, there's a government program called the National Flood Insurance Program. And on the property and casualty side, there's information on the exam in the form of questions related to that, so you'll need to learn that later in the course, as we'll cover. Another example would be Medicare. Medicare is health insurance for those age 65 and older. Okay? So that's part of Social Security. That's a government federal program. Medicaid is another big one. Health insurance, they sometimes refer to it as medical welfare. Depending upon the state you're in, the state administers the program, so it has a different name depending on your state. The federal name for it, though, being Medicaid. So we go a little further on, the third paragraph from the bottom of page 5. Domestic, foreign, alien. Very easy questions. Hopefully you see at least one or two of these on your exam. This has to do with where the company's home office is. If the insurance company's home office is within this state, they are domestic to this state. If the insurance company's home office, if they're domiciled in another state, but they're selling in this state, they are a foreign insurer. And the last furthest one away would be if they are out of the country, then they are referred to as an alien insurer. Okay, so companies based in Canada, selling in your state. What type of insurer are they? Alien insurer. Keep in mind, foreign here does not mean another state. It means does mean another state, does not mean another country. So when you hear that word foreign, normally you think another country, but here they use it as another state, alien being another country. We go to the last paragraph on page 5, authorized versus unauthorized. Now I have a couple synonyms for these things. Right above authorized, write this, admitted, and right above unauthorized, write non-admitted. So just some synonyms, just some synonyms there for you. Okay, so we have authorized or admitted. What does that mean? That means that the insurance company has been authorized at the state level to sell insurance in the state legally. So the license they obtain is called a certificate of authority. So this term, unauthorized or non-admitted, means that the company does not have a license to sell in the state. And if they are doing so, they are in violation of state law, and they're doing so illegally, with 2 exceptions. So what am I telling you here? I'm telling you there are 2 companies, insurance companies, that can sell in the state without getting a license. What are they? Got to know for your test. Number 1, surplus lines. I already said that. Number 2, reinsurance companies. Neither one of the 2 have to be licensed to sell in the state. So by definition, they're unauthorized or not admitted. But it is legal. They make an exception in those 2 situations only. Okay, so we go ahead to the next page. Top of page 6, first paragraph, we have financial status. Says independent rating services. Maybe a test question on here, maybe not, but this has to do with the financial services such as Standard & Poor's, Moody's, these organizations that rate various corporations related to their financial stability. So there's the key right there. Insurance companies are also rated, but it's for their financial stability, not for the premium they charge. Now, this is going to be a consideration of a person who wants to purchase insurance because obviously as a consumer, I want to know what's the financial stability of the company I'm purchasing my insurance from. Well, I can go right to the library, rent out, check out one of these Standard & Poor's guides or Moody's guides, take a look up. They have the various rating keys such as AAA or A, triple plus. Okay, they use these different ratings, usually number or letter ratings, to rate a company. But they're not insurance companies, they're rating organizations, and they rate companies based on their financial stability. Okay, so we go on to the next heading there, marketing systems. Now here we get into the different ways insurance is marketed and sold to the masses. Now as far as an agent goes, there's primarily 2 different ways that you could work as an agent once you get your license for exam purposes. So we have the first one there is the 3rd paragraph underneath that is called independent insurance producers or agents. Remember, synonymous. As an independent agent, you are self-employed. So I want you to think of it this way. You get your license, you open up your own insurance agency, you start selling insurance on your own, you sign contracts with as many companies as you want, and you market the products of those companies to the public. Pay all your own expenses. Earn commissions from the sales of those policies. That's how you make your living. So we have independent agents, number 1, self-employed. Own the expirations of their policies. Okay, so very important. Own the expiration of the policies. If the policy renews, that independent agent has the right to switch their customer to another insurance company if they feel so, that's going to be a benefit to that customer. So we have independent agent. We have the next paragraph, captive or exclusive agent. Captive or exclusive agents are people that work for a company and sell the policies only of that company. So you see a lot of companies where they will only allow you to sell ABC insurance products or XYZ insurance products, and they own those expirations of those policies. And if you leave that company, they keep those policies. None of them come with you. Okay, that's a captive or exclusive agent. Now, marketed a number of different ways. We have the 4th paragraph from the bottom, direct writing companies. Example of a direct writing company would be Geico, where you call in. They have people that work there a lot of times on salary. They're in call centers. It's an incoming call thing only. They have their advertisements on TV. You call their 1-800 number. It goes to one of the call centers throughout the U.S. and incoming calls to the people. And they answer, give you quotes, get you signed up. Okay, so that's direct writing. We have franchise marketing systems in that next paragraph there. And a good example of this one would be a company called Aflac. Does just this. They specialize in selling insurance to employees that have group coverage. So they can buy supplementary coverage right from Aflac. And then we have last paragraph, non-insurance sponsors. This would be your banks and also vending machines. So a lot of financial institutions are selling insurance. You get a loan, they can sell you what's called credit insurance, life insurance, health insurance that covers that loan, property insurance as well. Basically, what the situation is the bank itself is not the insurance company. The bank signs a contract with an insurance company who actually issues the policies and covers the claims. The banks just sell it at the point when the person is obtaining the loan. So it's kind of a point of sale, type sale. So it's added, the bank gets paid a commission on that sale, and that's a non-insurance company sponsor selling an insurance product. And so you see a lot of people, which probably some of you watching the course work for banks, you're getting this license to sell just those products I mentioned. So we go on to the next page on page 7. Top of the page we have the setting producers/agents. You guys, you get your license. You're representative of the insurance company. See what it says on here of importance for us. Says that as an insurance producer, generally you do not have the authority to issue or modify insurance contracts. Well, obviously the insurance company is going to have the authority to modify the contract with consent of the insured. The applicant can change an application. If you take an application from a person and they want to change something, you just get their initials on the change that they made and submit that to the insurance company. It says in the the next paragraph, property and casualty producers have more authorities. They can issue binders. Well, a binder is something that creates immediate coverage. So you'll learn more about that when you study the law portion of the exam, which you'll need to print off there. But it goes over binders and the state requirements on issuing binders and all that. But generally, life and health insurance agents cannot issue binders. However, property and casualty agents can. We get in the very center of the page on page 7, we have law of agency. Okay, this is something that's becoming more important for your exam. The law or doctrine of agency states that as an agent, you are a representative of the insurance company. And since you are a representative of the insurance company is responsible for your acts while you are out selling insurance. So we have up here, we'll list the insurance company. Down here we have the agent. Under the law of agency, the insurance company is referred to as the principal. So the agent is a representative of the principal in the sale of insurance. Now, under the law of agency, you've got to know that the insurance company is responsible for all acts of the agent while they are selling insurance. So if the test is to say the insurance company is responsible for all acts of the agent 24 hours a day, 7 days a week, is that true? No. Only while they're selling insurance. Okay, so we go on ahead of that, and I'll mention the book though on page 7, third paragraph from the bottom there, highlight the underlined statement. That's where it tells you that term principal. The insurance company is referred to as the principal. Now we get into at the bottom of the page different types of authority. Now if I'm an insurance agent, I want to know what I can and what I can't do. What the insurance company is giving me the authorization to do. There are 3 types of authority. You've got to know these for your exam. We have the second paragraph from the bottom on page 7, express authority. Authority that is granted in the the producer or agent's contract with the insurance company is express authority. Okay, so how is express authority expressed? It's written. Now we have the next one, which is implied authority. Implied authority is authority that you have to conduct customary business operations as an agent that is implied by your insurance company. Collecting premiums is a good example of implied authority. So for example, I collect a premium from an applicant and submit it to the insurance company. It does not expressly give me that authority in my contract. However, the insurance company accepts that premium and issues the policy. They have implied I have that authority. Now, it's a general business practice as an insurance agent to collect premiums from the applicants. Okay, I have to do that. Well, it's an implied authority, though, not expressed, because it's not in writing in my contract. Now, there's one last type of authority on the top of page 8, which is called apparent authority. So I want you to mostly focus on the first 2 types of authority. I've never seen or heard of questions related to this last type of authority, but for explanation purposes, it's an authority a third party is led to believe an individual has. It's apparent to the third party, whether it be your customer or possibly another insurance agent, that you have this authority. That's apparent authority. On page 8 in the second paragraph, now we have this term fiduciary. Fiduciary is a term linked to any person who's in a position of financial trust that is handling someone else's money or property. So this would be a real estate agent, insurance agent, trustee, banker, attorney. I mean, a number of different people fit this definition. It's only, though, as an insurance agent, when you're acting in a certain capacity, that you're acting in a fiduciary capacity. Question would be when? When are you acting in a fiduciary capacity? Think. Well, you see on page 8, the third paragraph down, they mention, or second paragraph down, premiums. Well, if you're collecting premiums from the applicant, you're acting in a fiduciary capacity. you have the responsibility to forward those premiums to your company, okay, for coverage. So that's where that term producer comes in. First, second, third, fourth paragraph down on page 8, highlight the first sentence, fiduciary duty to the insured or applicant, and then the fourth paragraph down, producer owes certain general responsibilities to the company. So we said, you're a representative of the company, that's who your duty is to. In the bottom of page 8, the last two paragraphs, we have what's called errors and omissions. Now, errors and omissions is similar to malpractice liability. So I talked about malpractice liability earlier when I related it to plastic surgeons. Well, you're going to need malpractice insurance in case you get sued by one of your customers. So say that you forget to explain an exclusion to a customer, or maybe you forget to tell them about a certain provision or exclusion in the policy. They have a claim and it's not covered, and they blame you. Excuse me. That you are going to have an errors and omissions claim. That customer is going to sue you. And when they do, you can turn that claim over to your errors and omissions policy. So errors and omissions is your malpractice insurance. It's a type of professional liability insurance. Now, if you're going to be an independent agent, you're going to have to purchase that yourself. If you're going to be an exclusive or captive, you might have that provided by your company, or you might be responsible for purchasing it from them. We go ahead to page 9, top of the page, and we have contracts. Okay, this is very important for the exam. There's a lot of information related to this, usually, and it all has to do with contract law. So earlier in this hour here, I said that, earlier in the section, I said that you have to know contract law because insurance policies are legally enforceable contracts. And this is true. Top of page 9, if they include the 4 essential elements of a legal contract. So we have the 4 essential elements you can remember with this acronym, COLE. So we've got 4 things here, starting with what's called consideration. And this is very important for the exam. You have to know consideration is defined as an exchange of values. And we've got the two parties here. We have the insurance company and we have the applicant. And here's the consideration to the contract. The applicant does 2 things: money, premium, and the second thing is answers on the application. The insurance company, one thing, they promise to provide coverage. Okay, so we have down here the applicant. Let's just give an example. We'll say that the applicant pays a $200 premium and they obtain $100,000 of life insurance coverage from the insurance company. Now here's something you need to know for the exam. Is consideration required to be equal? And the answer would be no. So is it equal here? No. I pay $200, I die, the insurance company pays $100,000. Is that equal? No way. Not even close. Well, it's not required to be. Okay? So remember, defined exchange of values. Both party has to bring something of value towards the contract. Now we go back up here and we have the second one is offer. Yeah, this down here is the applicant makes an offer to buy. We have number 3, which is acceptance. And this is done by the underwriter at the insurance company. So the underwriter accepts you as a risk and they issue the policy. Okay? So that's acceptance. Now these two together are sometimes referred to as a meeting of the minds. And you'll want to write this there in your book. Also known as mutual agreement. So a meeting of the minds or mutual agreement, same thing. They'd say which 2 contractual elements consists of a meeting of the minds? And the answer would be offer and acceptance. Now we have this last thing, which is really a 2-parter. We have legal purpose and legal capacity. So the contract must be for legal purpose. So I'll say that I wanted to insure a shipment of drugs that I had coming up from Colombia. And I was worried in case the Coast Guard was going to catch us and we'd have to dump it overboard. Can I buy insurance for that risk? No. There's no legal purpose to the contract. Legal capacity, good example of this. Mel Gibson, famous, world famous, right? And, also famous for his drunk driving incident that he had. Well, he was going, what? 2 times, he's 2 times legal limit, going 3 times the speed limit. Somebody has to be of sound mind, legal age, not under the influence of drugs or alcohol. So Mel Gibson comes in to see you to buy some insurance. Stay away from him, right? Nick Nolte too. If the guy's under the influence of drugs or alcohol enters into the contract, it's null and void. It's not legally enforceable. Okay, so these are the 4 essential elements. You've got to know them for your test. We move on the page to the paragraph below legal purpose and legal capacity. We have in that paragraph the doctrine of adhesion. Quick explanation of this. Doctrine of adhesion applies to all contracts that are written by one party without the ability of the other party to modify, which applies to insurance contracts. They're take it or leave it contracts. I have no right to modify the language in the contract. And since that's the case, the doctrine of adhesion applies. If we go to court, meaning I'm the insured and against the insurance company, and the insurance company is trying to contest a claim based on unclear language in the contract, they will lose 100% of the time under this doctrine. So they have to stick or adhere, doctrine of adhesion, to the contract language that they wrote. No room for argument. Next paragraph, we have this term representation. Definition you've got to know. Truth to the best of my knowledge. So back down here, we said, the applicant has to list answers on their application. True. There's 2 different types of answers. There's what are called representations, which are a truth to the best of the client's knowledge. And then there are what are considered warranties. A warranty is a guarantee of truth, and usually has to be in writing and sometimes is required to be notarized. Now, when we're talking about life and health insurance, I can't really make a warranty. I can make a truth to the best of my knowledge. So if they ask me, do I have a health condition, I can say no, I don't. That's a representation. Hey, I could have a health condition and not know about it. So it's a truth to the best of my knowledge. However, if we're talking about fire insurance, and they ask me, do I have a sprinkler system in my house, in the ceiling, in the roof? I say yes or no. If I say yes, I make a warranty that I do. And generally I'll get a lower premium for that. Now, if I lie about a warranty, it's called a breach of warranty, and the effect on the policy, well, the insurance is going to be the insurance company will void it. So it's called a breach of warranty. We have also in the paragraph on representation what's called the doctrine of utmost good faith. States all parties to the contract are supposed to be honest. Is all there. The next paragraph we have a 2-parter concept here called doctrine of waiver and estoppel. You've got to know the definitions here. Waiver is defined as the voluntary giving up of a known right. Estoppel is the inability to enforce the right in the future. So by definition, the insurance companies, if they fail to enforce a provision in their policy, that by definition is a waiver. Once they do not enforce that provision, they are stopped from enforcing that provision in the future because they made the waiver. This is referred to as the doctrine of estoppel. They are stopped from enforcing it because they made a waiver. We have the second paragraph from the bottom. Concealment and fraud are in there. Material concealment would be something that's important to the underwriter. And a concealment by definition is something you're hiding. So if I'm filling out an application for health insurance, they ask, do I have diabetes? And I leave it blank. I have diabetes, I know it, but I don't want to tell them because I know they might charge me a higher premium for my coverage. So I leave that off. That's a material concealment, which in turn could be defined as fraud. Fraud is the intent to deceive. Either one of those 2 could void the policy. So the insurance company has the right to void the policy if I can conceal a material fact or I commit fraud. And then last paragraph on the page, there's where they mention warranty. Warranty, guarantee of truth. If I lie about that warranty, it's called a breach of warranty, and the policy will be voided. On the next page, top of page 10, we have in the second paragraph a term called unilateral. Unilateral means the policy is one-sided. It applies to all one-sided contracts. With all insurance contracts are unilateral. So here's an example of how. I buy life insurance. If I have a claim, if I die, the insurance company is bound by the contract to pay. They're required to by law. Now, on my part, I have to pay my premium. What if I don't pay my premium? Can the insurance company force me to pay my premium? No, they can't. Policy will lapse, right? Okay, so unilateral, one-sided, only one party performs, that's the insurance company. Next paragraph, we have a term called aleatory. Now this relates to the unequal exchange of values and the uncertainty in the future. So the outcome of an insurance contract depends upon chance. And it will always be of unequal benefits to either party. By definition, it's an aleatory contract, is what that means. Now we have the next paragraph where they talk about loss exposure. In here, probably another test question, 1 if not 2. We have this definition of hazard. Now a hazard is something that increases the risk of loss. So increases the risk, increases the chance of loss. The person who's going to be most worried if a hazard is present is going to be the underwriter. Okay, because they're going to try and prevent, issuing policies that are going to have a loss. So if a hazard's present, the insurance company, the underwriter, could add an exclusion, might charge a higher premium, or they might deny writing the policy altogether. 3 different types of hazards for the exam. We have number 1 listed in the paragraph, a moral hazard. So without the E on it, without the E, you're lying to me. Moral hazard is somebody who lies, cheats, steals. If you've ever seen those Ocean's 11, Ocean's 12, 13, 14, 15 on down the road here, those guys in those movies, they're moral hazards. You do not want to sell insurance to them because who knows? They could be lying right through their teeth, right? And it's very hard to tell that. So we have a moral hazard. A morale hazard is a careless person. So they have a devil-may-care attitude, such as Mel Gibson. Hey, he fits right in here. Morale hazard. Careless person. Do you really want to sell auto insurance to a person who's going to get drunk 2 times the legal limit and go 3 times the speed limit home? No, you don't. That's a morale hazard. We have the last one, which would be a physical hazard. Good example of this, wet leaves on the sidewalk, oily rag in your garage, storing gasoline in your garage, ice on the sidewalk. Dr. Atkins, the guy with the whole Atkins diet deal, that's how he died. Came out of his apartment, slipped on the ice, cracked his head open. That's how he died. Okay, ice hadn't been there, wouldn't have happened. Physical hazard increased the chance of loss. And that's going to be the end of the section. So you're going to want to read your key facts, take the practice exam after the end of the section until you can get a 90%, and then move on to the next section, and I'll see you there.